property, and that's the big thing that's been missed with all of this. We have people in emergency accommodation. We need landlords to provide accommodation because we can't have just everybody in state housing, right?
Yeah, 100%. And it has been missed a lot, except by property people.
Yeah.
They beat that drum a bit, which is fair. Over 80% of New Zealand's housing stock is owned by mum and dad investors.
Yeah.
And they provide housing at a far cheaper rate than the government does. And everyone knows that. You don't have to go very far to open the paper in a week and see government's rented a whole motel. And it's not just
at $1,000 a night per room.
Yeah. The national government's doing it now as well.
Yeah.
Because they have to. There's a housing shortage in New Zealand.
Welcome to Checks and Balances. I'm Michael Vincent. This is James Blair. And today we've got Matthew Harris, tax extraordinaire par excellence, talking to us about the 2 tax changes that are going to change this property market.
Welcome, Mr. Taxman.
I'm back, baby.
To talk tax. You know, when somebody comes into a podcast recording episode with printouts from the IRD website, I know we're in for one hell of a time.
Yeah, well, you know, you're dangerous when you don't know what you don't know.
All right.
Especially when your industry is all bred off fear of being taxed or getting something wrong.
Yeah.
It's a great way to live your life.
Well, it's just changed so goddamn much.
Yeah.
You know, I had to actually stop and think about where interest deductibility was at right now because it's just got so stupid in the tax game and property.
Yeah, so let's talk about that today. So Labor came in 6 years ago, made some changes. Nationals come in, they're undoing the changes. That's going to have some impact to the property world. Tell us about this bit. What's National up to? What's going to happen?
Yeah, so, I mean, I think probably useful to really quickly recap some of the things that Labor did do, and not all of them are changing back. So during that time that Labor was in power, they made quite a few changes to the way that property market's regulated and rental market's regulated, and also quite a lot of tax changes. In summary, they introduced ring fencing, which is when you can no longer offset losses from property against other types of income.
How many years has that been?
See, I can't tell you exactly, but I think it was 2018.
And do you still get, because I don't sit that far away from the accounting team. Clients are still asking, aren't they? Where's my refund, Matthew?
Oh, I get it commonly. And that's one of the rules that I wasn't unhappy with, right?
Yeah.
Because
I think that's reasonable.
Yeah.
Because you still have it in Australia where they can kind of offset their losses in their property against their personal income tax, is it?
Yeah. So it skews decision making, right? And property as a business should be treated as such. So I thought finally landlords who are traditionally in New Zealand especially very bad at raising rents, we're going to have a bit of a coming to God, some market value realities we're going to come in. So that happened. I wasn't too unhappy with that. And then of course what happened right after that, interest rates went through the floor. Negativity dried up and those people didn't realize that it happened. So now we get it all the time now that we're back in the losses, heavy losses. People ring up and ask where the tax refund is. Anyway, that happened.
Can I have a tax refund?
You can't have a tax refund, no. And so what that happened, and then the other things that happened is that the bright line rule got changed from 2 years, which was the original amount, to 5 years. That was the first change by Labor. And then the second change was for non-new build properties. So what we call in situ properties. Yeah, they went from 5 years to 10 years.
A decade.
To
stop people flipping houses. A decade.
Yeah. Quasi capital gains tax.
Yeah. And very quickly, Matt, what is Brightline?
Brightline is a rule, a name for a rule, which is a line in the sand. It means if you buy and sell a property within a certain period, the Brightline period, then you pay tax regardless of your intention.
Okay.
So people probably recall from previous podcasts or videos that I've done that New Zealand has an intention-based regime, which put with relation to property, which put pretty simply means your intention when you purchase the property will dictate how it's taxed.
Yeah. Okay. Surely that's all the changes Labor could have made in that period of time. Surely we're done.
Well, you think so, right? Then what they did is they dropped a bomb on the property and tax world. So generally when rules are changed in the tax and accounting world, there's consultation. There's first of all some warning that it's going to happen, and there's consultation. That consultation goes on for some months. Every stakeholder in the accounting world has some say, and then the rules are changed, and whether those stakeholders were acknowledged or not varies, but often there are some small changes.
Yeah.
What happened is the government came out of nowhere and they blindsided property investors with the removal of interest deductibility. So that was a big one.
Yeah. And I think it's a really important point here is because we're saying, the government did this, government did this, the government did this. It's not that we are bashing the government as such. It is the changes and the way that they were enacted, right? And if we look at interest deductibility, it was marketed as we're cutting this tax loophole for property investors. Explain why it's not a tax loophole.
Yeah, so that was one of the things that really annoyed me during that period was the landlord bashing and the loophole. It's not a loophole for the very simple reason that it's very well understood in tax and accounting that if you are deriving income and you spend something to derive that income, so for example, we employ staff in order to make money in this business, we're allowed to deduct that cost of that staff against our income before we pay tax.
Yeah.
It's called Nexus with Income. It's in Part DA1 of the Income Tax Act, without being a nerd. Oh, that didn't come across well, did it? And it's a really well understood concept in tax, not just in New Zealand, basically worldwide. So the reason it wasn't a loophole is that if an investor buys a property and they use debt to fund that property, there's a cost of that debt. They have to pay the cost of that debt before they can derive any real profit.
Yeah.
That's not a loophole.
Without doing that, effectively we're paying tax on a profit that doesn't exist sometimes.
Yeah, exactly. I think we'll go through a quick example that Ravi's really helpfully prepared for me later, which will illustrate it really well.
Yeah.
But what I didn't like about it, other than the fact that it was uncommercial in every sense, was that there was two sets of rules for effectively the same people.
Yeah.
So you had property investor number one, who was an in situ property investor, so they bought non-new builds. They still provided accommodation for someone. They still had a mortgage. They still had repairs, maintenance, rates, insurance, all the same costs as everyone else. They couldn't deduct interest. But then if you bought a new build property, you could still, so you had the same thing going on. You had a tenant, you had insurance, you had a mortgage, you paid interest. You could deduct it. So tax systems are meant to be horizontally and vertically equitable, which is just a really fancy way of saying they should treat two people in the same situation, I see you laughing, the same way, and two people in a different situation differently.
Yeah.
It's a really easy concept
It's
to
fair.
understand. It's fair.
Yeah.
It's called equity.
Yeah.
The other piece I think about as well is comparing it to essentially any other business opportunity, right? Property is just a form of business. You could pour capital or pour debt or the opportunity into property, or you could go do something else with it. And creating different systems with different opportunities when essentially they're both businesses trying to derive an income and doing something good for New Zealand.
Yep.
Maybe a business might be employing people, adding a service to a business or helping somebody some way. Property, and that's the big thing that's been missed with all of this. We have people in emergency accommodation. We need landlords to provide accommodation because we can't have just everybody in state housing, right?
Yeah, 100%. And it has been missed a lot, except by property people.
Yeah.
They beat that drum a bit, which is fair. Over 80% of New Zealand's housing stock is owned by mum and dad investors.
Yeah.
And they provide housing at a far cheaper rate than the government does. And everyone knows that. You don't have to go very far to open the paper in a week and see government's rented a whole motel. And it's not just
at $1,000 a night per room.
Yeah. The national government's doing it now as well.
Yeah.
Because they have to. There's a housing shortage in New Zealand.
Yeah. Okay. So we've had all of these changes.
Yep.
Then completely separately, we've got the Reserve Bank as well that's talking about debt to income ratios. Obviously, interest rates have increased a lot over that period of time. Now, have we got any other changes? Surely there's no more changes.
No, there's some more changes coming, right? So all those changes happened. And what they were trying to do at that stage was to cool a very hot housing market. But of course, in typical New Zealand fashion, instead of putting pressure on the supply side, which is consenting, infrastructure, all the things that are quite difficult to do, they decided to whack the demand side, which is obviously remove tax deductions, make it hard to borrow, et cetera, et cetera, et cetera. So all that happened. And I think, there was an understanding probably at least by property investors that it wasn't very fair.
Yeah.
So the national government, as part of their election promises, and you've got to take election promises with a grain of salt. They are a bit of a lolly scramble. Sometimes they come through, sometimes they don't. They promised to reinstate interest deductibility for investors. I think it was a really good move because you can't have a tax system that treats two people in the same situation differently. And more than that, if you want these people to continue to supply accommodation in the market, then you have to allow that deduction, otherwise it becomes uneconomical. And if it does, imagine a situation where 80% of the property owners in New Zealand decided to leave that, who's going to pick that up?
Yeah.
That would not be good.
That would not be good, no. And so what happened is that they made some election promises to reinstate interest deductibility, and then what additionally happened is they followed through with that.
Yeah, nice.
So what's happening and when is it happening?
Yeah, cool. So for this, for the 31 March 2025 year, which has just begun, so remember tax years run 1 April to 31 March, we are back at 80% deductibility.
Nice.
So that means 80% of the cost of our mortgage is tax deductible. Remembering we still pay 100% of the cost in reality. And then by 31 March 2026, which is just one more tax year's time, then we will be back at 100% deductibility.
Back on parity.
Just about time for another election.
Yeah, 100%. Yeah. And have them all unwinded again.
Yeah.
So that was one major change, and that has been confirmed. The other change which has been confirmed but hasn't been confirmed is that bright line. So that's that period that was 2, then 5, then 10 if you bought an in situ property, is going to roll back to 2 years from 1 July.
Yeah.
This is a big change for a couple of reasons. One, it substantially reduces the holding period required for both in situs and non-in situ, so new builds, from a minimum of 5 to 2. So it's a huge reduction.
Yeah.
And it's grandparented, which is just a fancy way of saying that it applies earlier. So if you have held a property at 1 July for 2 years, you will be able to sell
Instantly,
without triggering bright line.
Yeah. Which I think is the correct thing to do.
Yeah.
I mean, it was all brought into design to people stop, buying and selling, flipping houses really quickly and not paying any income tax on it, treating it like it's a business and they're not paying their fair share of tax on it.
Yep.
10 years?
Yeah.
10 years?
Give us a capital gains tax.
Yeah.
So I agree with you. I think 2 years is a perfect amount of time. It's meant to stop short-term speculation. Who does a short-term speculation over 2 years?
Yeah, exactly.
So
So James, before we continue, I have got a special announcement.
Have you started sticking to your budget?
Absolutely not.
You finally made it as an after-hours DJ.
I wish. Mate, the thing is, we have got a brand new podcast partner, Partners Life.
You mean the award-winning insurance provider with over 300,000 Kiwis insured?
Yep, they're also a New Zealand operated company and they are passionate about increasing financial literacy amongst Kiwis.
Sounds like a great match. Where can I learn more about them?
Check out their website in our show notes below.
Really thought DJ Magic Mike was going to be a global sensation for a second. So Matt, I know you've run the numbers on the tax you pay on the current set of rules versus the proposed changing rules.
Yep.
The other interesting piece is we have done this in the past, but we did it with 3% interest rates a couple of years
interest
ago.
rates were sky high at 3%. I cringe.
So Matt, run us through the numbers.
Yeah. So you did right. This is going to be 7%, which is, a lot of our clients.
If you fixed at the end of last year, that's over 7.
Yeah. That's what you're at. The 6-month rate. What's the 6-month rate at the moment?
At Westpac, I think it's still 7.
7.15.
Yeah.
Here we go then. So this is a $900,000 interest only mortgage. So we've got 0% interest deductibility. So that's assuming that everything had carried on to the way that it was meant to under the Labor regime.
Yep.
So we have rent of $700 per week for 50 weeks. So we always use a little bit of vacancy. That's $35,000. Then we have expenses, really common property expenses. Rates, $2,700. Insurance, $1,500. Repairs and maintenance, $1,200. We have no interest deduction because it's 0%. Our total expenses are $5,400. That brings our net taxable profit to $29,600. And using a 33% tax rate, we will pay tax of $9,768. So the interesting thing here is that our net cash flow as an investor is $30,568. So the investor who owns that property has provided accommodation in New Zealand for $700 a week to a family or otherwise, and they have to fish out of their own pocket $30,568 to own that property.
Because the other big thing is, while you're not able to claim that expense, the interest costs as an expense, the expense doesn't go anywhere. You still have to pay
someone
it,
still
right?
has to pay the money.
Yeah, correct. It just comes out of the calculation.
Yeah. So in the current world with a 0% deductibility on that loan, we're having to fork out $30,000. And I think it's a really interesting way you put it. You're giving somebody the opportunity to live somewhere for $700 a week.
Yep.
It is costing the person $30,000 a year to be able to provide that accommodation. What does it look like under the new world?
Yeah, so, and I mean, the important point there is, yes, those investors are trying to obviously make a gain over time, But if it becomes uneconomic, then they're not going to do that anymore. So thankfully, interest deductibility is back. So in this current year, which is 1 April 2024 to 31 March 2025, we have an 80% interest deductibility environment. So let's do that same example, right? We have rent of $700 per week, $35,000. Then we have the same expenses again. We have rates, $2,700. We have insurance, $1,500, repairs and maintenance, $1,200. Then we have an 80% interest deduction on a $900,000 interest-only mortgage at 7%, $50,400. So still not very pleasant to be a property investor. Your total expenses, though, have gone to $55,800 from a tax perspective. So obviously before your total expenses were still actually more than that. That gives you a net taxable loss of $20,800. So tax is 0%. Your net cash flow is still minus $20,800. So it still costs you $20,000 odd to own that property, but you're not paying a tax for the privilege of doing that.
So in that example, you're $10,000 better off with the changes that are coming through, opposed to 0% deductibility.
That's correct. And the next year, you'll be another $5,000 better off.
Yeah. I mean, if we're thinking about like mum and dad investors, average sort of income, 10 grand, 15 grand, $200-$300 a week. We're thinking about cost of living, the way people are living at the moment, their own personal mortgage and the interest costs on that going up. This is a huge difference.
Yeah, it's a huge difference. And I'm very happy to see it, because there was a danger that if this had carried on, the property market in New Zealand would substantially change.
Yeah.
And either the government would have to step in, or housing supply would dry up immeasurably.
Yeah.
Because there wouldn't be incentive for developers, for example, to build properties for investment, because no one's going to buy them. The investment properties that are currently out there would be sold. They would be swallowed up by immigration and demand and supply issues. So we'd get more owner-occupied houses, less investments, and the government would have to step in.
Yeah. And for everyone thinking that, if everyone just sold their houses, everyone would buy their houses and there'd be an equilibrium. The amount of population growth and immigration coming into the country means that we have a shortfall of houses anyway. So no, it's not going to even out. There wouldn't be an equilibrium. There would still be a housing shortage, and it would be a more expensive cost to the population of the government coming in and stepping and renting entire motels for $1,000 per room per night.
And the other thing that would happen, which happens a lot overseas and in places like America, for example, is you get huge
homeless.
Sorry, you would get homeless. Well, we've already got that problem. But you get huge corporates come into the market, and they buy up large, but they are not the same people as mum and dad residential landlords. They do not have the same empathy. They raise rents a lot more efficiently. They minimize costs a lot more efficiently, and they pretty much just run a different model of housing. And New Zealand would be a different place.
We should do a podcast on it at some point, because that stuff is crazy. When you see they own, like 400,000 houses or 500,000 houses. It is insane.
It is.
Yeah. And people can't compete with them because their balance sheet is billions of dollars. So they'll just keep going up, up.
Yeah, the BlackRocks, the Vanguards. It is a very good idea, Mike. And let us know in the comments if you'd like us to do an episode on that podcast. So Matt, what is going to happen? So these changes have come through. I guess the question is, what's the impact going to be on the property market?
Yeah, I think we all know that the property market's a bit sluggish at the moment. Property markets are driven by sentiment and by credit.
Yep.
It's very difficult to get credit at the moment, and interest rates on that credit are really high. So I think the immediate impact is that probably people who might have sold when the 1 July 2-year bright line comes up, because you remember a lot of people will be on 5-year bright lines. And so not only are they getting killed in the pocket, if they sell, they're going to get taxed on losses effectively from their cash flow. So it didn't make any sense for them to sell. I think a lot of those people might hold off now. They might wait it out, wait for the environment to get a little bit better. The reality is that we have high immigration and we have a housing shortage, which is getting worse again. So I think there's some light at the end of the tunnel for investors. If you're a property investor and you can afford to hold on a little bit longer, then you should consider that if your financial circumstances allow it.
Yeah. I do worry about the light being a bit too bright at the end of the tunnel. I like, you start to think about where interest rates are, record low consents for properties, the immigration numbers coming out. We're in a technical recession, but per capita with the migration numbers, it's far worse than that.
Yep.
When you think about the output per person.
Yep.
And then, so interest rates will start to come down at the back end of the year, which will create market confidence. I wonder if property prices are going to start to ramp too much, which is very hard to think about the last couple of years. Like, what a great problem to have. But obviously, we want sustainable growth.
We can't have it again.
Yeah.
But I'm with you. It's hard to see how that wouldn't happen.
Yeah.
You can't put extra people into an economy in a country and have less places for them to live, and then expect the places that are available to purchase to be cheaper.
Yeah, especially as immigration coming into the country, that doesn't impact demand straight away. There's a lag on that because they have to roll on to a visa situation that allows them to purchase. And these people are usually driven to work and to buy houses. So it's all kind of ramping up. That actually, if that cash rate drops too quickly, we will just see an absolute takeoff.
And then we'll be back in that traditional New Zealand cycle, boom and bust in the property market, and everything follows.
So, Matt, we've got a lot of property investors out there in the moment that are feeling the pain. Some of them are very confused about what's going on with all of the changes.
Yep.
If those people are listening to this and they're thinking, I don't know what to do, what should they do?
Yeah, I mean, look, first of all, we're with you. We're property investors ourselves. We work with thousands of property investors in a year. We understand how it is. So just keep looking forward. But if you need any help with anything at all, just reach out to me or one of the other members of the accounting team. We can talk about strategies to reduce debt. We can talk about tax deductions, interest deductibility, anything like that. Or we can send you out to the mortgage team or the wealth team to look at the wider solutions that might be available to you, so that you are in a position when the market does get better. And remember, markets always get better.
Yeah.
Nowhere in history have they not got better again. Then you can capitalize on that. So do reach out.
Cool. Okay. Thank you very much for joining us, Matt.
Pleasure.
Please make sure to subscribe to the podcast, give us a review and a like, and always a big thank you to Partners Life for sponsoring us.
Cheers.
Thank you,
Section
Partners Life.
17C of the Property Tax Act. Talk taxi to me, Matt.